Hi, young Warren Buffett. Welcome to Shake Inside. Now we are going to learn about the nuts and bolts of fundamental analysis. Technical analysis requires fancy chart, candlestick pattern, and hundreds of indicators. But you are a future Warren Buffett and you require only data. Because fundamental analysis relies on information that readily available and often free. And most companies provide the data you needed for fundamental analysis, and there are also plenty of online services where you can download and analyze this information. Now let's talk about the three key financial documents that form the foundation of fundamental analysis: income statement, balance sheet, statement of cash flow. Is it difficult to understand? Don't worry, I will break down this and explain you with example. Assume you are a coffee shop owner. First up, we have the income statement. It is also known as profit or loss statement. This statement tells us how much money a coffee shop made or lost during a specific period, like a year or a quarter. It shows the coffee shop revenue, the money it brought in. Example, assume a cup of coffee is rupees 20 and you totally sold 500 cup of coffee in a day. What is the total amount now? 10,000, right? And it is called revenue. The money it spent to make that money. Example, to make 500 cup of coffee, you need milk, sugar, coffee powder and other expenses. So this money goes out of your pocket. These are considered as expenses, right? Look this image. This is a Starbucks income statement. When you hear news stories about how much a company earned in a quarter or in a year, that information comes from the income statement. Now next we have the balance sheet. This document reveals how much money a company has and how much it owes to others. It's like a financial snapshot of company asset. It means what it owns and its liabilities. It means what it owes. Wait a minute. Do you know the exact meaning of equity? Not sure. No problem, I will explain. Equity is the amount of capital invested or owned by the owner of the company. The equity is evaluated by the difference between liabilities and asset. You can think of it as the company's net worth. Now a question arises in your mind. What about my money? I bought a share. Don't worry, your money is also considered as equity because you also own a piece in ownership when you buy a stock, right? So shareholder money is also considered as equity. To help you visualize this, let me use the example of a coffee shop. Imagine you want to start your own coffee shop. The asset of your coffee shop would include things like coffee machine, furniture, cash and register, and any money owed to you by customers. These are the things that coffee shop owns. On the other hand, liabilities would include things like loan you took to start the coffee shop or money you owe to suppliers like milk, coffee powder, etc. Equity would be the difference between your asset and liabilities, which represent your ownership stake in the coffee shop. Have you understood now? This is the balance sheet of Starbucks. Let's talk about the statement of cash flow, which is important for understanding how cash flow in and out of a business. In our coffee shop example, this statement tells us how much cash the shop makes from selling coffee and how much it spent on things like rent and ingredients, etc. By looking at this statement, we can see if the coffee shop is bringing in enough cash to cover its expenses and make profit. For value investor, the cash flow statement is a crucial tool. It helps them assess a company cash generation, earnings quality, free cash flow, capital allocation decision and financial stability. By studying this statement, they can find undervalued asset with a great long-term growth potential. So, by analyzing the income statement, balance sheet, and cash flow statement, we can make smarter investment choices based on a company financial health. This is the cash flow of Starbucks. If you found this video helpful, like and subscribe. Thank you for learning. Happy investing.